Hello and welcome. Today we're diving into capital budgeting. It's the crucial process behind a company's biggest and most important financial decisions. So let's put you in the driver's seat. Imagine you're running a growing coffee chain, and you get this opportunity to buy a state-of-the-art roaster. It costs $500,000. Now, it could revolutionize your business, right? Better coffee, more production, but is it actually worth it? How on earth do you make a call that big? Well, to even begin to answer that, we have to talk about the one thing that fuels every single business: capital. Simply put, capital is the money a company needs to get started and to keep the lights on day to day. And, capital isn't just one big pile of money. It's helpful to think of it in two different ways. On one hand, you've got fixed capital. This is the skeleton of your business, the big, long-term stuff like buildings and machines. On the other hand, you have working capital. Think of this as the flesh and blood, the money that's constantly moving to pay for things like coffee beans and employee salaries. And here's a great way to picture that working capital in action. It's a continuous cycle. Cash goes out to buy raw materials. Those materials become finished products. You sell them, and hopefully even more cash comes back in. This flow is absolutely vital for a healthy business. But let's go back to those big skeleton decisions, like buying that new roaster. An investment in fixed capital isn't part of the daily flow. It's a huge, long-term commitment, and for that, you need a much more rigorous process. And that special process, well, that's what we call capital budgeting. It's the formal, structured way that businesses plan for, evaluate, and finance those massive long-term investments. It's all about making smart choices for the company's future. So why all the fuss? Why this whole formal process? Well, the stakes are incredibly high. First, you're talking about a ton of money. Second, the impact of these choices can stick around for 5, 10, even 15 years. And maybe most importantly, these decisions are pretty much irreversible. You can't just return a $500,000 roaster if you change your mind. So that brings us to the real question, right? With so much on the line, how do you actually weigh the pros and cons to make sure you're making the right call? Well, companies have a few tools in their toolbox. One of the most straightforward methods is called the payback period. It's just what it sounds like. It calculates how long it'll take for the project to earn back the money you initially spent on it. The general thinking is the faster you get your money back, the safer the investment. It's definitely simple, which is nice, but that simplicity hides a really significant flaw. It basically treats all money as equal, no matter when you get it. And that leads to a pretty critical question. I mean, think about it. Isn't a dollar today worth more than a dollar you're promised 5 years from now? Of course it is. You could invest that dollar today and earn a return on it. This idea is a core principle in finance called the time value of money, and the payback period completely ignores it. This is where a much more powerful method comes into play: net present value, or NPV. NPV tackles the time value of money head on. It takes all the cash you think a project will bring in over the years and calculates what all that future money is worth in today's dollars. The whole idea behind NPV can be broken down into 3 main steps. First, you estimate all the future cash the project is going to generate. Then comes the key step. You discount those future amounts to figure out their value today. Basically, since a dollar tomorrow is worth less than a dollar today, we have to shrink those future amounts down. And finally, you add up all those today's dollars values and subtract what the project costs you upfront. And once you have that final number, the decision rule is incredibly simple. If the net present value is positive, the project is expected to create more value than it costs. It's a green light. If it's negative, it's a red light. So at the end of the day, that's what capital budgeting is all about. Whether you're using a simple tool like the payback period or a more robust one like NPV, the goal is to provide a structured, logical way to make these giant decisions. It helps turn a gut feeling into a smart, data-driven choice. One of the sources we looked at put it perfectly. A right investment decision is the secret of the success of many business enterprises. And that's really it. Getting these huge, irreversible decisions right is often what separates the good companies from the truly great ones. So, I'll leave you with this to think about. What's your $1 million decision? If you were in charge of a business you cared about, what big, long-term bet would you make to help it grow? It's a fascinating question. Thanks for joining me today.